planet.
Yeah, she has become the first woman to take over the reins at the Federal Reserve, and she's taking over after Ben Bernanke becoming the most powerful central banker in the world, arguably so. The question is where Yellen will lead the U.S. central bank and its stimulus of the U.S. economy. And Kyle Brown, he's been taking a closer look at that issue.
Taking the oath on Monday, Janet Yellen is considered a safe pair of hands to take over at the U.S. Federal Reserve. Backed by President Barack Obama, the 67-year-old economist is expected to continue the policies of her predecessor, Ben Bernanke, who is credited with ushering the American economy out of its worst crisis since the Great Depression.
I think we all agree, Mr. President, that more needs to be done to strengthen the recovery, particularly for those hardest hit by the Great Recession. We have made progress.
As a member of the Fed for more than a decade, including 3 years as Ben Bernanke's deputy, Yellen is not expected to stray from the measures undertaken by the central bank to stimulate a long-flagging U.S. economy.
It's a nice, kind of a seamless switch from the Bernanke head of the Fed to Yellen. They've worked very closely together, both on quantitative easing, on forward guidance, and now on actually tapering down quantitative easing.
The Fed cut interest rates to near zero in late 2008 as part of efforts to lift the U.S. economy out of recession. And Bernanke launched a program of massive bond buying to push down borrowing costs before tapering the measure. Bond purchases were reduced again in February from $75 billion to $65 billion a month. Yellen is expected to continue to wind down the stimulus program, but she's not likely to argue for a hike in interest rates until next year.
Staying in the United States, there are fresh concerns politics in Washington will weigh on the American economy. Treasury Secretary Jack Lew has warned that the United States could default on its debts unless the U.S. Congress raises the debt ceiling. Without it, he says the United States will run out of cash to meet its obligations by the end of the month. Democrats and Republicans in Congress have locked horns over the past few years a number of times over the debt ceiling as they squabble over how to cut the U.S. budget deficit.
The truth is, the longer we wait, the greater the risks become. Whether it's the economic recovery, the financial markets, or the dependability of Social Security payments and military salaries, these are not things to put at risk.
Another warning there from Jack Lew. And one more note on the United States. American manufacturing has been picking up pace in the past few months, but fresh figures show that growth slowed down significantly in January. A closely watched index that measures manufacturing fell from 56.5 in December to 51.3. That's still over 50, which signals an expansion, but it's the lowest reading that we've seen since July over in the United States. Harsh winter weather is being blamed for part of the slowdown. Meanwhile, Eurozone manufacturing is actually picking up, and it is at its highest level since 2011. That's according to the Purchasing Managers Index from research firm Market. Germany is leading the way, and its manufacturing sector is at a 32-month high. Remember that a reading over 50 signals an expansion. Both Spain and Greece are above that key threshold. In Greece's case, for the first time since 2009. Also, Germany powering ahead, as you can see right there. France is the one weak spot as manufacturing is still contracting in this country. Now, traders on both sides of the Atlantic seem more fixed on the weak US data than the strong European figures, and the warning from Jack Lew onto that. And on top of that, we're seeing American stock markets trading well below the flat line this session after a weak January. February is off to a weak start over in the United States, with the Nasdaq down 2.8% or nearby that level. European markets, they were also dragged lower by the weakness over in the United States. We saw the Frankfurt DAX and the London FTSE trade down by more than 1%. Looking at some other news, cold weather was seen to keep American car buyers away from showrooms last month. Ford, General Motors, Toyota and Volkswagen have all reported weaker US sales figures for January. GM predicts that monthly sales for the industry as a whole were 15.3 million cars in the US. That's a smidgen higher than the same month in 2013, but well below analyst expectations. Chrysler, Nissan and Subaru provided some bright spots with their sales ticking higher. And a French business delegation has kicked off a visit in Iran. It comes as President Hassan Rouhani is trying to roll out the red carpet for foreign investors to revive the Iranian economy. The delegation from France includes executives from oil company Total, engineering firm Alstom, and carmaker Renault. It's the biggest European trade delegation to visit Iran in over 30 years' time. That's the business news for now. Over to you, Laura.
Thanks very much, Marcus. And we're going to take a short break here on France 24. We'll leave you with web news.